In this video, I'm going to show you the three main types of institutional trading. As you may know already, institutional trading is the kind of trading done by hedge funds, banks, and large companies. These institutions trade for several reasons beyond making profits. For example, a bank trades mainly to transfer the risks of their credit operations. A large company can trade in order to hedge some of its future contracts against currency fluctuations. The first type of institutional trading is simply speculation. Speculation means conjecturing about the future direction of price. That sounds obvious for most retail traders because all retail traders are also speculators. Even though institutional and retail traders can share this mode of trading, the way they approach the market can be vastly different. A retail trader might be primarily concerned with technical indicators or finding a quick formula to exploit the market somehow. An institutional speculator will employ a more sophisticated analysis of the market using professional price action analysis, macroeconomic analysis, and so on. Speculation is the least used mode of trading among institutions because it's the most difficult to do and the one that has the least amount of science to back it up. In other words, even though there is science behind professional speculation, there is also a strong component of art and talent to it, unlike in the other types of institutional trading, which are much more scientific and mechanical. The second type of institutional trading is called arbitrage. Arbitrage simply means exploiting the difference between two or more markets. Observe that it is vastly different than speculation, where the trader will conjecture about the future direction of the market. In arbitrage, the direction of the market is not relevant. The trader is primarily concerned with the discrepancies between two or more markets. To give you a simple example of what arbitrage is, consider the food market of two nearby cities. In city A, you can buy an apple for $1, and in city B, you can buy an apple for $1.20. When there is a discrepancy between two markets that sell the same good, there is a pure arbitrage opportunity. To make money in this situation, you can buy the apple in city A for $1 and sell the apple in city B for $1.20 for a profit of 20 cents per apple. The more people realize this opportunity exists, the quicker the arbitrage opportunity will disappear, and the two markets will reach the equilibrium. That's the intuition behind arbitrage. In today's electronic markets, this type of pure arbitrage is no longer possible, but there are other types of arbitrage that can be done based on statistics, for example. That's one of the institutional trading methods we are going to explore later this year when I release the books about institutional trading. Arbitrage strategies are very common in hedge funds. In fact, they are perhaps one of the most used types of strategies in these institutions. Arbitrage has a lot more use in the institutional domain than speculation is because there's a lot more science behind arbitrage strategies. An institution like a hedge fund will always give preference to strategies that have a stronger scientific backbone. The third type of institutional trading is called hedging. Here we have to be careful about what hedging really means and how it's done because, for some reason, the retail trading community has the wrong idea about it. Most retail traders believe that hedging means buying and selling the same financial instrument at the same time, but that's incorrect. In the institutional domain, hedging means buying and selling financial instruments that vary differently across time. The most common example of institutional hedge is buying derivatives and selling stocks simultaneously. Hedging can also be done entirely using derivatives, but that's a more complicated story that we will explore in the books about institutional trading later this year. In the last decade or so, there has been a lot of stigma about hedging in the retail trading community, and it got a bad reputation because people started to apply it in the wrong way and for the wrong reasons. The main goal of hedging in the institutional domain is the transfer of risks or the minimization of risks. Hedging is primarily done by large banks as a way of transferring the risks of their credit operations to the financial markets. In fact, that's what a bank trader does. The goal of a bank is not to profit in the financial markets. It's to manage the risk of their primary source of income, which is lending money to individuals and companies. These types of operations represent many times the volume done by speculation, even though it doesn't seem like it. In this sense, the financial markets serve as a giant risk transferring machine. Retail traders and investors help a lot in this process because they create a lot of liquidity and volatility in the markets, which is precisely what hedgers need in order to be successful. This is also why there has been a tremendous incentive for the small retail trader to get in the market in the last decade or so. After the 2008 financial crisis, the global financial system learned that risks should be more carefully managed by large institutions. The relaxation in the entry barriers for the retail trader are partly a result from that. Hearing all of this might make you think that there is not much left for the retail trader in this game, but that's not true. Large institutions have a series of regulations and rules to follow that a retail trader simply doesn't have. The best case scenario for a retail trader is to learn how the institutions really trade and then use these methods for their own advantage without the need of following the regulations of a hedge fund or a bank, for example. That means that retail traders can be in the best position possible if they learn how the institutions work. That's one of my goals here in the channel, to show you how the large institutions operate so you can be ahead of this game and have the best chance of making money like a professional would. The challenge is to learn the deeply scientific methods of institutional trading, but I'm figuring out a way of teaching such methods in a way that you don't really need to understand complicated formulas. You just need to learn the practical side of things. I hope this video was useful to you in some way. If you enjoyed the material I create, please help support the channel by clicking the like button, subscribing to the channel, and leaving your feedback below in the comment section. If you want to learn professional speculation methods, check out the video courses I created in the video description. Thank you for watching and take care.